Hey guys, welcome back to the channel. Today we will be talking about valuation and why it matters. As usual, none of what we say is financial advice and what we say is purely educational. Now guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it. So for those of you all who are kind of new to investing, or maybe you have not heard of the term valuation, we'll start off with really what we think is business valuation. And before you actually even go into figure out that, right, you have to realize that in the stock market, there is two very important components. And the first is price and value.
Yep. So, it's very simple, only.
Yep.
Price is actually what you see. It's very tangible, right?
Yes.
So you can see on the screen what's the share price trading, but value is something that is intangible.
Right.
Nobody can actually see it because you need to do the work so that you know the actual true value of that particular company.
And so what's interesting is that value, certain components of value can be calculated on a piece of paper or an Excel spreadsheet, but certain things cannot be counted.
Yes, correct.
Right?
So
and you know, but just because you cannot measure it doesn't mean it doesn't count. I think Einstein said something like that before.
Right. Okay.
Right.
So actually, valuation is very simple. Actually,
Yeah.
You just need to know whether are you overpaying or underpaying for a particular company? And it also means what is the risk versus reward ratio. I believe everybody, you guys hear this a lot of times. And also it is basically what is your margin of safety of that particular your investment that you put inside a particular company. So this is a chart that is showing you what is valuation. Why does it matter? Because it shows you what's the intrinsic value of a particular company.
Yes.
Yeah, and you know once it falls out below that range of that buy zone, so you know when to start allocating capital and buy some.
Yes, of course, this is a very nice chart that they draw for you. This is only in theory.
Yes.
But the basic idea about valuation is also that, right here we put overpay and underpay, right? What that means is that there are periods in the stock market, not always, in fact, not often probably, where the market starts to dump shares that should not be dumped so hard or buy shares that shouldn't be supported. So as we can see in the recent tech sell-off in the US and in Malaysia, all of these companies have great stories and they are backed by figures. Then it's real, Tesla and the likes are all gonna just grow from here, right? But people overpaid for that and they think that, hey, as long as it keeps growing, it's worth holding. And of course, we know now, tech has, recently there's been a bounce, but by and large, it's still down. A lot of people are losing money. And then at the flip side, a lot of people started to ignore areas that were unloved, such as oil and gas. And yet we see now oil and gas doing so well. And so what this means is that, valuation is just trying to help you figure out where we are in the cycle. And financial markets, like the stock market, is essentially a cycle.
Yes.
Right? There's euphoria and then there's pessimism. And so you want to buy from the pessimist and sell to the euphoric. That's in a nutshell what it is.
Yeah, or Warren Buffett's famous quote, buy when other people are careful. And
Now, the other thing to think of is this concept of margin of safety. This is something that's mentioned a lot about in the investment circle. But the basic principle of margin of safety is exactly what you imagine it to be, right? It's the same reason why you don't tailgate someone on the highway, right? You don't drive right behind the person. Now, in theory, if you're a good driver and the other person is a good driver, it could work out, right? Nothing will happen. But as we know, you never know what can happen.
Yes.
Right? The lorry on the other side of the lane starts to crash over from the border. And because you didn't have any margin of safety, i.e. you weren't maybe 10, 20, 30 feet away from the car, or meters as well, then even if both of you are good drivers, half a second of slip up
Correct. So actually, you brought up a very good point, and that actually shows you why valuation is not 100% correct.
Exactly.
All the time.
Exactly.
It could be 99% or 98% because of that 1% or 2% uncertainty that caused their valuation to actually be useless or like doesn't really apply already in that particular scenario.
Exactly.
So yeah, that is where your margin of safety comes about lah.
And so when you look at this chart, right, it's trying to say, margin of safety is the difference between the price and the intrinsic value of the company. But what I would argue is that even when you are trying to calculate and figure out the intrinsic value of the company, that itself also you need to apply margin of safety. So for those of you who don't know, intrinsic value is essentially how much money the company can generate in its lifetime. That's really what it is. And when you try and do what we call forecasting of cash flows, of profits or whatever, you also need to apply what we call a discount rate. And the reason you apply a discount rate is this margin of safety. You assume, look, I think this company can probably go at 15%. Or right now is growing at 15%. But why not let me just forecast it at 10%? So that's the whole
correct
principle.
Yeah, and I think in the next segment, we're going to be talking about the variables of valuation.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description. Okay, so when we are trying to figure out the value of a company, we always want to look at the factors or variables, right?
Yes.
And so, of course, profit and cash flow is up there.
Yes, correct. So, I mean, this is a very general and simple one. Basically, the share price of the particular company movement is actually dependent on how well the company's earnings is actually doing in the future.
That's right.
So, if let's say the profit they make about 2 times than it was before, most likely their share price will also follow suit.
Yes.
Yeah, it's simple as that. And the second variable is that there may be like unforeseen event. So for example, like COVID-19, nobody actually anticipated this will become like it's a global...
Well, Bill Gates predicted it, so except only him.
Yep. So, but not many people actually actually expected this to happen. Yeah, and then there's like a worldwide shutdown, lockdown and everything.
And I think no one expected the response also. Right? I mean, certain countries, their lockdown was very, very fast. And then we have countries like China, which is still in lockdown. So this recording. So.
And also, other than COVID-19, there's also the 9/11 situation.
Exactly.
Yeah, I mean, nobody also anticipated that. And then there's the Ukraine-Russian war. Even though there are signs already about that war to start to come, but nobody expected it to become so big. So these are unforeseen events that actually can cause valuation to drop massively.
Yeah, that's true.
Yeah, and it's pretty much unanticipated.
So wait, to be more precise, these things actually, as we alluded to earlier on, these things actually affect more on the price rather than the value.
Yes, correct.
So that's what makes it very interesting, because although, yes, perhaps things like COVID caused like supply chain issues where, in the short term at least, the cost of transporting goods is higher. But it doesn't affect it as much as, let's say, the price. The price can be a massive underreaction or overreaction.
Yes, correct. So yeah, you pointed out very correctly, which is it only affects the price.
Yes.
The value is still maintained, but just the price. Exactly. Okay, and the third one is the special events.
Yes.
So I think we covered a video on the 3 versus 3 on the third quarter's report, right? So some companies are announcing special dividends, and that actually cause their share price to actually go up because people see like there's a much attractive dividend yield when you invest in a particular company. So there's more interest in the stock. And another thing is takeover and also privatization. Yep. So you never know when a company start to take over, and when they take over, you also need to find whether is there like a disparity between the current share price and the buyout price that they're actually offering to. Yeah.
Correct.
So yeah, I think that's the variables.
So before you go on, right, I think really what this is in the industry, we call this a catalyst, right? You have positive and negative catalysts. And very often these catalysts are things that can actually affect the sales or the earnings. So tying it back to the very first variable, which is profit and cash flow, that is essentially what these catalysts can do and how it can change the valuation of the company, both on the price side of things and the value side of things as well. So that's what makes investing difficult, but also interesting. And because of you bringing up things like unforeseen events and special events, that's why the concept of margin of safety is very important.
Yes.
Preparing yourself.
Yep, correct. Okay, so but that doesn't mean that when you do all those valuation, right, you are actually at zero risk. I mean, there is still risk. I mean, just now you gave the example of the tailgating a car behind.
Yes.
Even though if let's say both are safe driver, but you never anticipate maybe there's a lorry behind you that knocks you over.
Yeah.
And that causes an accident. So again, valuation is not always absolute. You cannot just take it based on face value and you need to discount it. To be safe.
The joke is sometimes, let's say if you forget when you don't know whether your anniversary is with your girlfriend or wife is on today or this week, you just buy flowers for both weeks. Don't play it safe. That's really what it is.
That's true.
Yeah.
And also you need to know that it may change over time also. Because you never know whether there's any unforeseen circumstances that actually affected your valuation to be deferred. And then you may need to change your mind when that happens.
Yes.
Don't stay like stagnant and just think that their intrinsic value is going to maintain forever.
Yeah, I think that's one of the ironically, not changing or not recognizing that change can happen is also a risk.
Yes.
I think a lot of investors faultily go into the stock market thinking they're going to get stable returns. And that, I would say, is the biggest risk of all. Because the stock market has... Okay, so it's very interesting, right? If I told you, right, that I've got this asset that will grow 9% versus 6%, right? Which one will you choose?
Of course, it's the 9%.
Right, but then I tell you, you know what? The 9% one, there's going to be a lot of ups and downs over the next 10 to 20 years. Which one do you choose?
If the 6% one is very steady and stable, I'll go for the 6%.
Right. But you see, if you think about it, right, at the end of the day, the big risk when you come into investing is not making returns.
Yep. Exactly.
Right?
Yep.
So why is it that when you've got something like the stock market that has outperformed, let's say, the property market, which has grown at 60%, 6% over time, why is it that people still don't put money into the stock market? And the big one is because they go in with the expectation that it's like properties.
Right.
But and 3%, as you know, over time is a lot of money, right?
Yep. But it's just that the thing is that property you cannot really see in the screen. I think that's the reason why also.
Yes.
I mean, which property investor will check the price of the property value every single day, right?
Exactly.
Yeah. So I think that it's I would say it's one of a safeguard material so that property investors don't get so emotional because they cannot see the price changes.
Yeah, imagine if you can only if the stock market only opens twice a year, something like that.
Yeah, it'll be same as stock. It'll be same as the property market lah. Yeah,
be a very rational market.
Correct. And there's also one more risk is the management execution.
Yep.
I mean, this is very salient because if the management decided to U-turn and then not perform right, I mean that also you need to change your thesis of the particular company lah. And I think that is the three major risks you need to consider when you're doing your valuation.
Alright guys, enjoying the video so far? If the answer is yes, remember, like, comment, subscribe. And as far as comments go, if you don't like the video, do let us know as well. We always take all sorts of feedback as long as they're constructive. So, one of the things that we like to do is to help people level up their investing skills through very affordable methods. So one of the ways that we implement valuation and go through all the details and the spreadsheets and what's important, most importantly, what is important and what is not important. Because if you Google online, you get a lot of information of valuation, but you're just going to get confused.
Yes.
And so what we do in our SIB or the Stock Investing Blueprint is exactly help you sort of shortcut and speed up your journey to learn what matters and what doesn't.
Yes, correct. And this is more of your DIY version.
Yeah.
We have a non-DIY one.
Correct.
Yeah, so this is a FIRL Pro. Basically, we ourselves, come out with these 12 ready reports, and these reports are actually stocks that we own. Also, we have
3 reports at least a month.
Yes, correct.
Right. So if you're someone who like, I don't really want to educate and learn myself, you want someone to help you do some of the work, because at the end of the day, you have to put in some work as well. Well, then FIRL Pro will make sense to you. We already have
12 reports, and it's going to be 15 soon, soon in this month.
Right. And then like some of them are already up 40% in a couple of months, right?
Yes.
So, and if you want to get a sample of what it looks like, just head over to the comment section or the description. Just enroll for free. You can watch a free video for the SIB one, and you can read a free article or report for FIRL Pro.
Yeah.
And guys, thanks for staying all the way as usual. And if you like this sort of content, let us know. If you don't like, also let us know. Always love to hear your feedback. And guys, as usual, thanks for the support, and we'll see you in the next video.